Hello, folks, and welcome to the famed State of the Markets meeting. Thank you all for joining us. We have a lot of registrants inside of the meeting this evening. I hope you can all hear me. And thank you again for attending. So let's jump into things. As always, I need to start with a few disclosures. Triumph Capital Management is a registered investment advisor with the SEC. This evening, I'll be making some forward-looking projections. I'll also maybe be talking about a few particular strategies and stocks and that type of thing. What I need for everybody inside of the webinar to understand, as well as anybody who watches this as a recording, is that these forward-looking projections are just that. They are my opinion. They are not necessarily the opinion of your financial advisor. And when I talk about things this evening, please realize that they are generalities. This presentation is being done for educational purposes. I typically do these once a quarter. So let's jump into it. Sometimes we do these live. Tonight we're on a webinar, so you don't need to silence your device, obviously. Okay. Little bit about myself. I have the distinct pleasure of serving as the CEO of Triumph Capital Management. If you hear an accent in my voice, I'm originally from Massachusetts. I've been in the business now for about 22 years this June. And I work with clients in businesses and charities every day to help craft different types of investment strategies, charitable planning, estate planning techniques, so on and so forth. Anyhow, tonight we're on the webinar, but your questions are welcome. So if you have questions after this presentation, feel free to email myself. You'll see my email at the end of the webinar, or you can email the firm at info@triumphcapitalmanagement.com. The agenda is action-packed tonight. We'll be covering how markets performed both in 2023, 2024. We'll cover earnings reports. We'll cover a bunch of economic indicators, so on and so forth. So please sit back, relax. I have you for the next hour, and as most of you know, I can get somewhat lengthy, but I promised myself in 2024, for those of you who've been on past webinars, you probably know at the last quarter I said I'm going to make a promise to everybody in 2024. I'm going to get you out of here within the hour. So let's jump into it. Market performance. We'll talk about how the markets have performed year to date, but let's do a little bit of a history lesson here. So most people know in 2023, the stock market performed very well. Most people also know, although we do have short memories, that in 2022, the market was down. When I say the market, in this instance, I'm referring to the S&P 500. In 2022, the S&P 500 was down 19.75%. We fast forward into 2023, the S&P 500 was up 24.73%. So it's down 19.75 in 22, up 24.73 in 23, okay? What a lot of people don't realize is that we started kind of off the year with a bang in 2023. Let me see if I can get my highlighter here. My laser pointer rather. We started off with kind of a bang through the month of January. We then had a sell-off. We then got into the months that we are in now, the second and third quarter, and those were pretty well, as you can see here, okay? The market started to come down, and when we got to the end of October for the year, things were just okay. Now, something really interesting started to come into the ether, if you will, at the end of October. And at the end of October, we started to get favorable inflation numbers. In other words, we saw inflation come from its high, okay, and we saw it continuously going down. And really at about November 7th, so the last 2 months of the year, we really had a great market. You can see that big uptrend inside of the S&P 500. So that is 2023. This continued into 2024, and we saw the markets do extremely well through January, February, and here we are kind of coming into March. But as of the close of business on the 29th of April, markets, or the S&P 500 for the year, was up 6.93, okay? If we look at the different indices, the S&P 500, I'm going to use SPY, again, up 6.93. If we look at the tech-heavy NASDAQ, represented by QQQ, up 5.25 for the year. And if we look at the Dow Jones Industrial Average, represented by DIA, up 1.44 for the year. We know what we've done at home, both with the S&P, the NASDAQ, and the Dow Jones. Let's take a trip overseas. If we look at emerging markets, Brazil, Russia, India, China, for the year, up 3.38. If we look at developed Europe, up 3.86. And if we look at those frontier marketplaces, such places like Colombia, Vietnam, so on and so forth, up 1.44 for the year. So when I show these numbers to you, please realize this. I was talking to somebody earlier today, and I shared with them these numbers, and they said to me, Derek, big deal, I can get that inside of a money market. We'll actually talk about money markets a little bit this evening, but realize this is just for the first part of the year, January 1st to April 29th. Obviously, if you're inside of some money market today, earning yourself 5%, that's great, but that's for the entire year, if you catch my drift. All right. Next, U.S. sector performance. So a lot of people think that the S&P 500 is this equally blended mixture of 500 stocks here in America. And in large part it is, but what folks need to realize is that it's not equally weighted. If you notice on the screen here, we'll start with basic materials. You'll notice the area that's inside of basic materials inside of the S&P 500 is only 2% of the entire S&P 500. So in other words, if you look at these different sectors, yes, you can see what each sector is either up or down for the year, but what you need to realize is inside of those 500 stocks, they represent different weights. You notice that energy is the leader this year. Energy is up 14.19. Again, this is as of the close of business on April 29th. Communication services. What are communication services? Stocks that fall into the communication service sector include companies like Facebook and Google, okay? And you'll also notice financial services. Financial services being, one of the top performing areas inside of there, up 8.56, representing 12%. Again, I want to focus your attention on weights, because what a lot of people, again, don't realize is we're not equally blended. In fact, if you look at technology stocks are companies like Apple and Dell and NVIDIA and Micro, so on and so forth. Those represent 30% of the S&P 500. Now, a lot of times communication services get lumped in with tech. Again, companies like Facebook, companies like Google, companies like Verizon, so on and so forth. And if you think about it for a moment, in large part, communication services and technology represent nearly 40% of the S&P 500. Question is the S&P 500 a good benchmark to grade your equities against? Often, if you're looking at an equally blended type of benchmark, the Dow Jones Industrial may be something better to look at simply because it's more equally weighted. In fact, if we dig into those sectors a little bit more, what I'm showing you here is I'm showing you the top 10 holdings inside of the S&P 500. Those include Microsoft, Apple, Facebook, Amazon. You see Google listed twice. Google goes by Alphabet, but these are just different shares of class. You see Warren Buffett's, Berkshire Hathaway, Eli Lilly's inside of there, Broadcom, so on and so forth. But these represent 32%. Just the top 10 stocks in the S&P 500 represent 32% of its overall weight. The other thing that I want to point out, that I'm going to take a little bit of a left turn here for a moment, okay, is that there are things called dividends. A lot of people do understand this, but they don't necessarily understand it. Here's what I mean by that. If you think about real estate for a second, some of you whom are clients have heard me use this analogy in the past, but pretend for a moment that you bought a piece of real estate for, let's say, $1 million. And let's say with that $1 million, it bought you 10,000 square feet of real estate. Now, let's pretend you're renting that real estate out. And let's pretend the rental on that real estate, you're collecting $50,000 a year of income, okay? Well, you would know that that real estate moves up and down in value. Unlike your stock portfolio, you can't log in every day. Yes, you could maybe go to Zillow and get kind of an idea of what it's worth. But pretend I'm your realtor and I call you up 3 years from now and I say to you, Joe, you know that piece of real estate that we purchased 3 years ago for $1 million, your 10,000 square feet? Today we did an evaluation on the building and it is worth 700,000. Now, what you wouldn't say to me is, you wouldn't say to me, Derek, did a floor blow off of my building, or do I have less square footage? No, you would know you still own 10,000 square feet. It just so happens that somebody's offering you less per square foot than what you paid for it. What your question would probably be, because in your mind, you read the newspaper, you watch the news, maybe the reason why it's gone down in value is the area it's in, or because of what's going on in the economy, so on and so forth. But your real question would be to me, Derek, am I still collecting my $50,000 in rents? And I say back to you, Joe, you are still collecting your $50,000 in rents. In fact, you're now collecting like $53,000 in rents. Why? Because rents go up over time. My point in saying this all to you is you will notice here that the S&P 500 today pays a dividend of 1.32, okay, 1.32, unlike that real estate at 5. That being said, the S&P 500 has increased its dividend payout over time, no different than how those rents get increased. Now what I want you to do is pretend I call you 3 years later, so now it's been 6 years, and I say to you, Joe, that real estate that you purchased for the $1 million, the 10,000 square feet, it's worth 1.4 million. And you would say, hey, Derek, that's great. What happened? Did I gain more square footage? Did we put another floor on the building or something like that? Now, you wouldn't say that. I'd say no. You would just say, yeah, I read the paper, I watch TV, I know what's going on in the economy. The price of my real estate went up. The question that you would ask is, hey, Derek, am I still getting that 53 grand in rent? And my response to you may be, hey, Joe, now you're getting 56 grand in rent, again, because rents go up. Now, the exact same things happens when you go to invest in stocks if those stocks pay dividends. The value goes up and down, but the dividends, okay, tend to still come in, especially in a diversified portfolio. Why am I showing you all this? I'm showing you all this. I'm taking a little bit of a left turn here, and I just want to break into federal tax brackets. Most people do know how federal tax work. I'm not going to go through the whole tax code here, obviously, but I'm going to make a point of 2 different tax structures. One is the tax rates that you pay on your ordinary income. So if you think about it, if you're a married person who files jointly, okay, what happens is you and your spouse have earned income coming in. That earned income includes money that you earn from going to work, interest that you perhaps earn like inside of a bank account. It also includes about 85% of your Social Security payments. It also includes pension payments if you have them. All of that money comes in and the IRS then says, okay, here's everything you have. We're going to let you take a standard deduction or an itemized deduction, and then you might have some credits, so on and so forth. But at the end of the day, what is left in your taxable income? And let's say your taxable income is, say, $100,000. What happens from a federal tax level is it works its way through these brackets. In other words, on your first $23,220, you're taxed at 10%. On the money that you earn between $23,221 all the way up to $94,300, you're taxed at 12. And then you just keep working through the brackets. We've all heard somebody say, I don't want to work overtime because it'll throw me into a new tax bracket. That is completely wrong. In other words, if you made $94,301, only that additional $1 is what's subject to the new bracket. Now, why am I showing you federal tax brackets when the name of this meeting is State of the Markets? And the reason for that is I talked a little bit about dividends, so I wanted folks to know that there is a separate tax rate on qualified dividends that you may receive from owning equities or stocks. It used to be very easy. It used to be that those were taxed at a flat 15%. There's also what is referred to as capital gains, or more specifically, long-term capital gains. A long-term capital gain is when you buy an asset and you own it for over a year and a day. If you own it for over a year and a day, it is now considered long-term, okay? Meaning that if you go to sell it and you sell it at a profit, you bought it at 10, you sell it at 12, on that $2 gain, you will pay a different tax rate than on those federal tax rates. It used to be really easy. It used to be 15%. What is it today? Well, the way that it works is you come up here and you go, okay, how much did I make? Depending upon how you file, single, head of household, married, or married filing separate, okay? And depending upon how much you had in earned income, your long-term gain and your dividends could be taxed as low as 0%, paying no income on them, could be at 15%, or could be at 20%. The government in their infinite wisdom. So how does it work? If you have a married couple filing jointly and their income is below $94,000, they'll actually pay a 0% tax rate. Now, if you have folks that are married and they earn between $94,000 and $583,000, they're still in that 15% tax rate. And then obviously, as you can see here, those over 583 are paying 20%. I bring this up simply to stress this out. I want to show you a quick case study. Recently, I had a young couple. They had a lawsuit. With the lawsuit, they won it, and they had an influx of money come in. They're newer clients, so we're just starting to put their money to work. But what you can see here on the screen is you can see they're invested in stocks. They're younger. They're not going to work anymore. They're going to be living off their portfolio. They need income today to live on, and they also need growth because they're young. They need growth for down the road. Well, if you notice right now inside of their portfolio, based upon their holdings, I have $77,359 of qualified dividend income coming into that couple. How much are they going to pay in taxes on that? As I showed you earlier, 0. The other part that I want to stress very quickly is when I say that, you say, well, you know, stock market's risky or the up and down, so on and so forth. Think about that real estate for a second. When I was giving you the analogy of the real estate, one thing that I said to you is I said, hey, you have your rents. But what if that piece of real estate that you bought is Circuit City and Circuit City goes out of business? Who's going to be your new renter? Maybe a Halloween, outfit that just rents it for a month in October, okay? But if you now thought about it, say you had a whole bunch of tenants like in an apartment building, yes, you'll have some vacancy. Yes, you might have somebody who doesn't pay their rents. But inside of an equity portfolio, if you notice here, this is actually a report. The names are blacked out. You'll notice that this report is 18 pages long. And what you'll see here is you'll see big companies such as 3M, Bivy, Philip Morris, Ontario, AT&T. And you'll notice that these are these little dividends that all these tenants, I'd like to refer to them, pay. None of these tenants pay a significant large percentage of that 77,000 that the client can expect to have come in. Diversification through the qualified dividends. Anyhow, market performance January 1st to April 29th. Again, S&P up close to 7%. NASDAQ, up 5.25. Dow Jones up 1.4. Why? Why have markets done what they've done? What is driving the markets? Some of this information is why you're all here tonight. So let's dive into it. The first thing that we're going to talk about is valuations, PE ratios. Most of you know what PE ratios are, but for those of you who do not, I like to explain it like this. If you own a private company, let's pretend you and I own an ice cream store together here on the 16th Street Mall in Denver, okay? And with that ice cream store, we go out there and we rent from the building owner. We have expenses such as employees and product that we're bringing in, cones and sugar and cream, because we make our own ice cream. And we've been running our ice cream store for the last 30 years. We want to retire. So we're going to put our business up to sale. Yes, we maybe hire attorneys. Yes, we maybe hire business valuation folks, so on and so forth. And at the end of the day, let's say every year we bring in approximately $1 million, but we get 900,000 in expenses. Therefore, we're left with bottom line of 100 grand. We could typically expect to sell our business for someplace between 3 to 5 times earnings. In other words, somebody would write us a check for 300 to 500 grand for the right to ring the register for the next 30 years. That's what's referred to as a privately held business. We are not publicly traded. If we flip that point over and we look at publicly traded stocks from 1994 until April 26th, on average, they sell at 16.65 times earnings, 16.65. What does that mean? Let's pretend our ice cream store was publicly traded. Again, we made $1 million. We were left with 100 grand bottom line. We would now get a price to earnings of 16.5 times. So all of a sudden, we'd be able to sell that business for approximately $1,665,000. Let's call it 1.7 million. Excuse me, I said thousand. We'd be able to sell it for approximately 1.7 million. Average P ratio on the S&P 500 going back 30 years, as you can see on your screen, 16.65. So if you think about it, why am I telling you what P ratios are? Well, think about it for a second. Most of you inside of the webinar, listening to this as a recording, so on and so forth, you know the price of some things. You walk into the grocery store, you know the price of different things. Or whatever you do for a living, you probably have a good feel. When it comes to stocks or equities or investments or anything like that, it's always funny when I talk to clients or potential clients and I say, why do you want to invest in that? And they go, well, I got to, so on and so forth. So one thing that we always look at is, hey, are markets frothy today? In other words, are stock prices too high? As you can see on April 26th, the average PE ratio of the S&P 500 was at 1 standard deviation above the average at 20. Based upon what I've told you thus far, that would indicate that stock is overvalued. The S&P 500 together is an overvalued index simply based upon S&P 500 metrics, okay? Back to what I said a little bit about things earlier, if I take the top 10 stocks out of the S&P 500, their current P ratio is 27, okay? Their average P ratio is 20, okay? If I look at the remaining stocks after stripping out those top 10 stocks, we actually have a P ratio that is right around the mean at 17.5. When I strip those 10 stocks out, the remaining stocks inside of the S&P, those remaining 490, actually their average is a bit lower at 17.5. If you look at those top 10 stocks in the S&P 500, and you look at their weight inside of there, as I showed you earlier in a few slides before, I think I showed you they represented about 32%. But because markets move on a daily, this data is as of April 26th. The last data I showed you is at the end of the quarter. They now represent 34% of the S&P 500. Think about that. 10 stocks represent 34% of the S&P 500, and they contribute to about 26% of earnings represented inside of the S&P 500. When you look at that, some people look at this and they say, hey, markets are so high today. This is a graph of the S&P 500. This graph is simply showing you growth of the S&P 500 and where PE ratios were at different inflection points. As you know, from 2008, this was the global financial crisis. We came out of the global financial crisis, and it's been a really good run up into the markets. We then hit, 2020, 2021. This was COVID. Look at what happened in COVID on March 23rd, 2020, after that huge sell-off in the market. You looked at PE ratios, they were cheap. They were well below the average at 13.3. And of course, COVID was a V-shaped recovery. We came all the way up to 2022. As I said earlier, market was down roughly 20%, market being S&P in 2022. PE ratios were very high. We had a big sell-off through 2022. Was that caused because you had high PE ratios? We'll unpack that a little bit, but we came down to lower PE ratios, lower than average. And of course, we've seen a market that's done pretty darn well. That little hiccup that you see right there, that's what I was referring to earlier. However, with that said, realize this. What you're looking at here is you're going back to 1950, and this blue graph that you see underneath here is the S&P 500. It looks a lot smoother because I'm going back to 1950. The red line is pointing out to you just kind of a smoothing action. And what I'm trying to point out here is there's periods that the S&P 500 plateaus, and then there's growth. There's periods where it plateaus, and then there's growth. There's periods where it plateaus. This is from 2000, okay, until basically, that was 2008. We came out of 2008, but really that was a very long plateau. Don't forget, we had two major recessions, dot-com bubble, okay, global financial crisis, and then we kind of worked our way out of that stuff, and that's been the market. There is COVID, and here we are today. And the question is, hey, do we continue to plateau, or do we go through another 10, 20-year expansion in the market? Well, if I were to go back and I look at these big expansions in the market, I can tie them to technological advances. If you go back into the 50s, where you kind of had this nice growth going on, think about it. You had all the GIs coming back from World War II. Think of all the technological advances, right? For the first time, there were refrigerators that you could plug into electricity, and they kept things cold, and cars, and everybody wanted a house, a two-car garage, so on and so forth. You got into, the 70s and 80s with cell phone technology. And of course, in the 80s, you had regulation changes, huge amounts of them, and real estate and tax code changes through the Reagan years. And in the 90s, you had a ton of growth, the dot-com bubble. No longer, if you and I own that grocery store that ice cream store, were we only selling to our local community. We can now open up a store online, and maybe the world is our oyster. The world is our customer. Our sales could potentially go through the roof. Obviously, we got into the 2000s, and I think the technological advances were just more acceptance of, the internet, and more acceptance of shopping online. And here we are today, and what are the technological advantages that we see? And we see them coming rapidly. We see a ton of technological leaps forward in the medical space, and we see a ton with, obviously, artificial intelligence. When I say artificial intelligence, I don't mean some robot who's your friend. I simply mean the processing of data at lightning speeds, which can then push itself across all sectors of the economy. It can help companies such as Marriott book better, and so on and so forth. And so will that push us into another 10, 20-year growth spur? on those P ratios, realize PE ratios adjust. So when we have high PE ratios, the question is this: does the stock come down in price to adjust to the company's earnings, or does the company earn more money and therefore stock price goes up, PE ratio kind of comes down, but earnings went up? So the question is, we're in earnings season now. So how do companies' earnings look? Okay. If I look at companies' earnings so far, we're about 45% through earnings season. In other words, we have a vast amount of companies who have already reported. Were they in line? Did they beat, or were they below expectations? The green bars there, when I say companies reporting their earnings, the green bars there represent companies that have beat expectations. They made more money than they were supposed to during the fourth quarter of during the first quarter of 2024. The red represents companies who underperformed, and the yellow is just companies that said, hey, we planned on making X and we made X. We didn't underperform or overperform, we were in line. We keep track of this. So this is a spreadsheet, as you can see, and this is just a snip. And if you're interested, you can see I adjusted my spreadsheet just to show you market weights. You can see Microsoft beat by about 4%. You can see Google beat by an astonishing 24%. Facebook beat by 8%. You see a lot of beats inside of here. So again, it's not necessarily just P ratios. If you have companies that make more money, their stock price would go up. And if the stock price stays flat, it doesn't go up by earnings, so on and so forth, that P ratio adjusts. That goes back to those super cycles, those 10, 20 years, okay? Today, this information is as of today. Today, before the market, we had some huge companies reporting. We had Eli Lilly, 3M, Coca-Cola, McDonald's, so on and so forth. Look at this, Eli Lilly, they reported before the bell. And their stock, as you can see here in this little tailwind, I took this snip today at 234. That would have been New York time. So the market was still open, but at the time, Eli Lilly was up 6% for the day. You notice here, Eli Lilly, look at that P ratio at 60, very, very high on a P ratio. But again, hey, are there earnings that are going to come in, start to put them in line with P ratios? You also notice I highlighted here yield or dividend. So you can see they also pay a dividend. Here's 3M. 3M came out. 3M beat earnings. They beat earnings by 13%. You can see that their stock went up by 4.21. Yes, still down for over a 1-year period of time, but up today because they beat earnings. You see PayPal. PayPal came out and PayPal beat earnings by about 8.65. You can see that their stock shot up 2.31. Again, you can see the timestamps there. By the way, McDonald's missed earnings. They missed by about 1%. And their stock today was relatively flat, okay? So the economy and the Federal Reserve, how are things looking? There's an old saying on Wall Street, you do not fight the Federal Reserve. Don't fight the Fed is how that term goes, okay? The Federal Reserve has something called the dual mandate. What in the world is the dual mandate? The dual mandate is the Federal Reserve wants inflation at 2 and unemployment at 4. Inflation at 2 and unemployment at 4. So where's inflation today? Well, inflation's been coming down. As you can see on the screen, we had inflation that back in March of 2023 was at 5.6%, okay? We're looking at core inflation here. So core inflation strips out food and energy prices, okay? So core inflation back in 2023 was at 5.6%. Again, the Federal Reserve, in their mandate, they want inflation at 2%. In order to achieve that mandate, one of the tools that the Federal Reserve employs is raising interest rates. When you raise interest rates, you cool down the economy. I like to say the economy is like a fire. When you raise interest rates, you're pouring water on that fire to control it, to calm it down, not to put it out, but to control it. And as you know, with the Federal Reserve's interest rate rising cycle, we saw inflation come down, okay? And here we sit today, last reading March 2024 at 3.8, okay? Now, I want to go back to that. We get our next reading, we get our April reading in 15 days from now on May 15th. Again, we saw the inflation number come in at 3.8. By the way, that was a little hot. That was a little hot. Expectations were that inflation would come in at 3.7. Now remember that I said that is a little hot because I'm going to tie a lot of these pieces of the puzzle together for you. Next, headline inflation. Headline inflation includes food and energy. And when we look at headline inflation, we noticed that headline inflation actually jumped up month over month from 3.2 to 3.5. In large part, that had to do with housing, that had to do with energy. We've seen prices at the pump go up, okay? Now, the interesting thing, as I said to you earlier, hey, the market, as of the close of business on April 29th, the S&P 500 up close to about 7%, 6.95. But interestingly enough, okay, what's happened during the month of April? You've seen this big decline. We started to recover a little bit last week, and obviously today and yesterday, big sell-offs in the market. But the question is why? Well, of course, one of the reasons why is we got that hot inflation number. We got that hot inflation number. That hot inflation number said, hey, listen, is inflation really coming down, or are we at a sticking point? Make comment on that, more comment on that in a moment. If you look at the relation between the inflation, between headline inflation and core inflation, they do kind of fall in the same path. But the reason why the Fed likes to have a number that they strip out energy and food is energy and food can be very volatile. If you have a drought, or if you have, not enough water conditions, or a freeze in Florida, it can cause different foods to spike up in price, so on and so forth. But you notice that with core inflation, that's kind of been staying even, and you actually, as I mentioned, saw a headline go up. So what I like to say is this: when we had inflation, if we went all the way back to like 2022, we hit inflation at like 9%. We've seen inflation come down from that. But if you ever gone on a diet and you said, hey, I want to lose 15 pounds, and you're really dedicated to it, you might shed the first 10 really easy. It's that last 5 that sticks on you. It can be really difficult to shred. And the question is, are we experiencing that today? You're going to start to notice in the headlines the question of stagflation, like, this stuff just staying even, this kind of hovering, not being able to get rid of that last 5 pounds of weight, okay? We'll see. I don't know. I'm not saying that's what's going to happen. I'm saying you're going to see that in the headlines. This is just going back to 74. So my last graph just showed you a few months. This is now bringing that same graph where you can see headline and you can see core inflation. And what I was trying to tell you is that that blue line, which represents headline, you can see it's just more volatile, although they do follow each other very closely. Again, the Fed's mandate is to have inflation at 2. Now, here's our forecast. You'll notice that the forecast, we see inflation numbers coming down. And we see that probably by this time next year, the Federal Reserve will have achieved their 2% mandate inside of inflation. I think that the inflation number that comes out on the 15th is going to be hot. In other words, I think it's going to be higher than expectations. Expectations won't come out until about the first week of May. I believe expectations, when I say expectations, I obviously have my own, but I mean, if I take the whole street's expectations and average them out, I think they'll come in around 3.7. I bet you will have inflation that is either at 3.8 or 3.9, especially on headline. The reason for that is obviously the price at the pump. And the price at the pump, yeah, it's come down a little bit over the last few days, but I'm talking about if we look at April in its totality. By the way, hotter than average inflation is something seen globally. So you can see in March of 2024, you can see developed countries on average, DM is what stands for developed countries at 2.9. You can see emerging market countries have hotter inflation at 4.3. That seems to a lot of the times be the case. What is considered developed countries? US, Canada, Japan, the UK, the Euro area, Germany, France, Italy, Spain, and Greece. And you can see that France has the hottest inflation, followed by Japan. You can see the US, so on and so forth. I'll make a comment of this later in the presentation about what their central banks, their Federal Reserves are doing. Unemployment. Remember, the Federal Reserve has a dual mandate. Inflation, 2%. Unemployment at 4%. Well, here's the thing. Unemployment has been well below 4% since we came out of COVID. Well below 4%. Derek, isn't low unemployment good? What the Federal Reserve tries to achieve is price stability. I've explained this in presentations in the past, but you may be scratching your head saying, why would the Federal Reserve want unemployment to go up? Here's why. If you and I, again, own a business together, let's pretend it's a, whatever, it doesn't matter what it is, just a business, and we need to hire a new employee, say it's somebody to run our tech department, and we put an ad out in the paper, and we put that ad out for $60,000. We might not get any applicants, so we have to then say 70,000, 80,000, 100,000, 200,000. Well, as we raise that salary, we'll probably get applicants, okay? But it's inflationary, right? It's inflationary. It doesn't allow us to pull from an employment pool. The Federal Reserve finds that the Goldilocks scenario, in other words, not too hot, not too cold, in unemployment is 4%. And when we're below 4%, we have inflationary pressures. So what do? They raise interest rates. They raise interest rates. Why? So companies lay off employees, or companies take their help wanted sign out of their door. If you think about that for a minute. Well, if you notice, back to what's going on in unemployment, we saw positive signs. We had an unemployment rate that was sticky November, December, and into January of 24. And then we saw it spike up. We saw it spike up in those first months of the year, okay? Remember, we want to see unemployment spike up. We'd like to see it go to 4. That would be positive for what the Fed's trying to do. However, what did we get on our last read? What did we get on April 5th? We got, okay, an unemployment number, okay, that went down, okay? It went down, right? And that's not a good thing. I know that sounds weird, but we want to see it go up, not down on the unemployment rate. We get our next read in 2 days. We'll see what that unemployment number is. The consensus is that it'll stay even at 3.8. But now think about this, tie this back to the market. Remember, we got that hotter than expected inflation. It was only 1/10 of a point, but it was hotter than expected. And we got a labor market that got hotter as well. In other words, unemployment didn't go up, unemployment went down, which a lot of times you would think is a good thing, more people working, so on and so forth. However, in this marketplace, it's not a good thing. Our forecast for unemployment is that we'll see unemployment start to go up. In fact, like I said, the old saying on Wall Street is that you do not fight the Fed. What is the Fed's intention of raising interest rates? It is to break things. What is it trying to break? Inflation ultimately, but one thing that it causes is it causes unemployment to go up. You don't fight the Fed because they'll win. The federal funds rate. The federal funds rate is simply the rate that the Federal Reserve lends to its member banks. In other words, back during COVID, People were refinancing their loans at 2.75 or what have you, their 30-year loans, right? And if you had a 5 or a 6 or a 7% 30-year mortgage and you refinanced at 3, it just put more money in your pocket. Well, if you look at this is 2016. Federal funds rate back in 2016, if you think about it, we were coming out of the 2008 global financial crisis. The federal funds rate back then was a low like 0.40. As the economy got stronger, the Federal Reserve raised interest rates, and they continued to raise interest rates up until about when COVID set in. You started to see them starting to cut the effective federal funds rate, not necessarily because what was going on here in the United States of America, but because that was sweeping around the globe and it came here to the US. And all of a sudden you see here the federal funds rate, when we go to look at it, we had it all the way up to 2.5. We went from essentially about 0.20 back in 2016. These little steps are 25 basis point raises, and we had it effectively at about 2.5%. COVID hit, federal funds rate dropped all the way down at one point to 0.05, basically free money, okay? It kind of fluctuated between 0.05 and 0.10, again, essentially free money. This is where you were able to refinance, your credit card APRs went way down, businesses that borrow money to make payroll and things, like that. Think about it, their interest went way down, variable rates went way down. And then what you had happen is in 2022, you had the Federal Reserve start to raise interest rates. The economy looked better, employment came back. We had employment that shot up close to 15% during COVID. Federal Reserve started to raise interest rates in March of 2022. Now, when the Federal Reserve starts to raise interest rates, what's everybody say? Hey, when you raise interest rates, what are you going to do? You're going to increase people's APRs on their credit cards. You're going to increase borrowing costs for companies. Therefore, profits won't be as good and stocks should sell off. What happened in 2022? Stock market was down 20%. Typically, that's what happens when the Fed starts to raise interest rates. Now, we started to raise in 22. And they effectively have the federal funds rate today. If you read it in the paper, it reads 5.5%. That's what the stated federal funds rate is. But because they bring this up in steps, the effective federal funds rate today is at 5.3%. Okay, 5.3%. Now, the Fed's last raise, even though in our mind it's like, hey, they just raised, their last raise was July of 2023. They haven't raised rates since then, okay? And so we've been holding steady right here since July of 2023, okay? I guess I did draw some pictures here as I was talking. Now, tomorrow marks the second day of the federal funds meeting. And around 12:30, I believe, 1 o'clock Mountain Standard, Powell will be on the podium talking. Powell, I do not believe that Powell will be raising rates tomorrow, and I do not believe that he'll be cutting rates tomorrow. Why? Well, everybody has their theories. Oh, it's too expensive to borrow money. Oh, it's too expensive to pay interest on our debt. Oh, he's got to cut rates. Well, listen, when inflation started to come down in 2000 and, it started to come down, since 2022, but when we started to get down to those low levels at the end of 2023, the talk was, hey, we should see the Fed cut rates 5 to 7 times through 2024. That talk, as we got through January, February, became, hey, you know what? The Fed maybe is only going to cut 3 to 5 times. That talk is now maybe they'll cut 1 to 2 times. In my guesstimation, based upon what's happening in the markets today, I don't see any reason why they would cut. I get all these mathematical examples where you can say, hey, if you have inflation down at 3.8, you shouldn't have a federal funds rate at 5.5, blah, 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 blah. What I'm trying to say to you is the Federal Reserve has a mandate of 2% in inflation and 4% unemployment. Our inflation rate is nearly double their mandate, and our unemployment rate, although at 3.8 today, okay, the labor market is still amazingly strong. Again, it's like going on a diet to lose 15 pounds, you've lost 10. What are you going to do to shred that last 5? If anything, I think that if the economy, the backdrop of the economy stays as strong as it is today, okay, that they may raise another 25 basis points, not tomorrow, but down the road. I think tomorrow, if the Fed is seeing strong economic data, as I'm showing you here, but their forecast is even stronger economic data, they'll start to bake that into the narrative. They'll start to say, we're going to be data dependent. Listen, the labor market's amazingly strong, so on and so forth. If they raise rates by 25 basis points, that's a huge U-turn from decreasing rates 5 to 7 times, okay? That being said, we'll get to it. We'll get to it. By the way, this is just a 30-year mortgage rate. This is showing you back from 1990 until where we are today. So today we're at 7.24. That's the national average for a 30-year rate in mortgages. You notice back here, it was really, really low. In fact, on average, the lowest 30-year rate back during COVID at 2.85. But here's the funny thing. If you just go back to 1990, it doesn't seem like it was that long ago. Look at where rates were back in 1990. Back in 1990, about 10.56. In fact, if you look above this line, because that's the 7% line, rates really didn't go below 7% until almost 2002. So it's not like things are drastically different. And did we have a great economy, minus the global financial crisis highly caused by lending and derivatives is a topic for another day? But yes, we did. Okay. We'll see where rates are going, and the new number came out today, and that's the average at 5.24. Okay. The secured overnight financing rate, so SOFR. What SOFR is it is the overnight borrowing rate. A lot of companies, to make payroll and banks lending money to each other, so on and so forth, they use the secured overnight financing rate. And what you'll notice is right, you had that rate, you can see it on the graph here, went very low, no different than everything else during COVID, and this follows all those other graphs. But the point being is when the Federal Reserve raises rates, it costs companies more money. When it costs them more money, what I'm trying to say to you is why do markets tend to sell off when the Fed increases rates? Because it's being said that the company's not going to make as much money, right? Like I said to you earlier, back to PE ratios. Now, the real question in all of that, okay, is even though this has been going up for companies, so on and so forth, what's the hedge to all this? The hedge to all this is wage growth, right? If companies are making more money, if people are making more money, inflation, so on and so forth, do you still have money left over to spend on those widgets? After all, what is the stock market? It's a conglomerate of companies that sell widgets, right? If you look at wage growth, over the last 12 months, we had wage growth come in at 5.77. We see a labor market. So what's going on with labor demand? We see a labor market. If we go back to March of 2022, there was about 2 jobs open for every person looking for a job. So there was 2 open jobs. Companies were hiring like crazy. We've seen that come down, but today there's about 1.3 jobs open for every person looking for a job, which is weird. If you jump over here and you look at quits, in other words, how many people are quitting? Look back here. This was back in 2022. You had a lot of people quitting their jobs. Some of you are maybe shaking your head and going, that doesn't really make sense. What do you mean? Well, what was happening is you had an engineer at ExxonMobil who is making 250 grand a year, he gets a call from Chevron, or she gets a call from Chevron saying, hey, we'll pay you 325, right? Because wages were going up like crazy, and they quit their job at Exxon and took their job at Chevron. Now, what you can see here is that that is going down. I talked to clients of mine, I talked to a lot of people, and the clients that I talked to are headhunters or who have been headhunted. Those calls are dying way down. You also see companies laying off a lot more than they were previously, right? And so that's why you see the labor market, yes, weakening, which is why our forecast is that unemployment goes up. But in our forecast, you notice we didn't show it go up to 14. We showed it go up just a smidget above 4. Okay. So now if I unpack this for you, over the last 12 months, what did you have? You had inflation, 3.8. You had wage growth at 5.8. So the average person got a raise of 2% on their money. If I unpack that a little bit further and give you the forecast, look, you have unemployment that's expected to go up. When you have unemployment go up, you have less money floating out there, less people buying goods. What does that do? It does dampen inflation. So our expectation is inflation come down, not to mention you got the Federal Reserve in there raising interest rates, which should cause inflation. And because you have unemployment going up, you'll actually see wage growth go down. Oh my goodness, Derek, that looks like a dismal picture. Hold on, let me getting all the little pieces of the puzzle. I'm going to put it together, okay? And I will give forecasts. When I look at the consumer, I'm interested, okay? I'm interested in what their balance sheet looks like. I'm interested in what their balance sheet looks like. When I look at that consumer today, the first quarter of 2024, they have less of their money going to debt service. What do I mean by that? Well, if you think about it, this is, you bring in $1,000 a month, let's say. How much of that $1,000 has to disappear to service debt? In other words, pay your mortgage or pay a credit card. Well, look at here. This was back in Q4 of 2007. It was about 13% of that $1,000. Today it's only about 10%, although it's gone up, right? Because you have people moving, and when they move, maybe they take on a new mortgage at 7.25 or what have you. Okay. One thing that I don't like to see, and obviously we've heard about this, is we see delinquencies going up. In other words, consumers being more delinquent on credit card payments or auto payments. And so what does that tell us, right? Is that saying, hey, listen, things are weakening, right? These are all pieces of the puzzle. By the way, real quick, I threw this in here, an earnings update, because when you think about wages, right, and all of that, again, what are companies doing? They're selling widgets. Yes, internally, companies try to become more effective, more efficient. They try to do things at a lower cost, so on and so forth. But at the end of the day, they're still selling goods. By the way, I showed this to you earlier, and I showed you some before the bell companies. Today, after the bell, which means after the market closes, you had a number of major companies reporting. To give you an idea, Amazon beat its earnings expectations by 17%. Super Micro beat by 8.3%. And Stryker, pharmaceutical company, beat by 6.2%. Headline that I pulled off of CNBC this morning, as you can see on the date stamp, Amazon profit more than triples, topping Wall Street expectations. So again, PE ratios, as I mentioned earlier. By the way, I'm going over here, but I apologize. I will finish up. Earnings continued. So Thursday, we have some big companies reporting. Apple, ConocoPhillips. You can see the list here. This is then followed by Friday. And then as we get into next week, you can see some big companies, Hershey's, you can see Simon Properties, you see Walt Disney, Occidental Petroleum, Uber, and Airbnb. We kind of are working our way through earnings season. It officially ends, or essentially ends, on May 14th with one of the last major companies reporting being Home Depot. Earnings, the reason why I've now brought it up twice, earnings is the biggest factor in determining a company's stock price. Therefore, where does that company go than any other? Yeah, there's all these economic things that make markets ebb and flow. But at the end of the day, if a company continues to earn money over time, you see their price, stock price, go up. Sorry for the deviation. What I also grabbed today was that the Dow tumbled 600 points. It wrapped up its worst month since September of 2022. Okay, if you look at the indices today, again, this was a snip from CNBC. You can see the S&P was down 1.6, the tech-heavy NASDAQ down 2%, and as I mentioned earlier, the Dow Jones Industrial down nearly 600 points, or 570, down 1.5%, the best of the three major indexes here. Why were markets down today? Why were markets down today? It's easy. It's easy. You don't fight the Fed. We're back to the Fed. Tomorrow, Chairman Powell comes out and he's going to give his speech. And the market in large part was off today. Companies are beating. Why are companies beating? They are becoming more efficient. They are lowering their cost of product, but the consumers out there buying widgets. The consumers very, very, very strong. And obviously, the Federal Reserve wants that to weaken, right? They want inflation to come down and they want unemployment to go up. By the way, this is a snip from the Federal Reserve's own website, essentially. And it's showing that even the FOMC, that's the Federal Operation of Market Committee, that's the Federal Reserve. What they are showing, okay, is they show on their own website their expectations of bringing down the federal funds rate, The funny thing is, typically speaking, market expectations are that it'll be quicker than what the Fed. This graph has recently changed. But again, you know, these are just forecast or forward-looking remarks. Anything could change on the anything can change. In other words, all of a sudden, if COVID or some other pandemic sets in 3 months from now, you would see this federal funds rate come way, way down. Again, if things stay as good as they are, I could see the Fed eventually making a case for raising interest rates. Now, let me say something. When the Federal Reserve took their interest rate, their federal funds rate down to close to zero, I was really scared. Why? It's like watching a Hollywood movie and the hero in the movie, he's out of ammunition. He's got no bullets left in the gun. The Federal Reserve had one interest rate cut left in them when we were down hovering around zero. What they've been able to do over the past few years is raise interest rates. In other words, reload those pistols, reload that ammunition. Today, with their federal funds rate at 5.5, okay, inside of a very strong economy, that action hero is reloaded. And they have that tool available to them. God forbid we have another pandemic or something like that. Now realize this is also going on around the world. So monetary policy worldwide, you can see the Fed, the ECB, Bank of England, Bank of Japan, all with the exception of the Bank of Japan. Bank of Japan was down around zero, so they've been trying to raise rates. In fact, the Bank of Japan even did this, where they were down around zero. What they said is, hey, if you keep too much money in your bank account, you'll actually lose money, right? You'll lose money. They'll charge you interest. So you see the Bank of Japan still expected to bring up rates, but everywhere else around the globe, everybody's expected to come down. We saw, you know, the Bank of Japan actually, even though they're expected to go up, they came out about, what's today, Tuesday? So on Friday, they kept their interest rates the same. By the way, very quickly, the bond market, we know what happened inside of the equity markets, both US and global. Again, this doesn't include today's trading. This was as of April 29th, so the close of business yesterday. This next graph, bonds, this does include market performance today. You can see the US aggregate bond index for the year, it's down 3%. You can see the international bond index is up 3%, and US agencies are up about 1.4. Let me show you this graph though. What you're seeing here is this is showing you the bond market. This is showing you the Bloomberg aggregate US bond market. The bars that are in gray to the upside show you each year since 1976 what the bond market's done as far as rate of return. And then the gray bars to the downside are again saying, hey, if the bond market was down in that year. The little red dots are showing you in any particular year what the bond market was down at some point. In other words, here we are today in 2024, making this 23, making this 22. In 2022 is the worst year for the bond market on record, down 13%. If you think about it, bonds are supposed to balance out your equities. Well, equities were down 20 and bonds were down 13. But why were bonds down 13? Because the Federal Reserve was raising interest rates, and there's an inverse relationship between the price of bonds and interest rates. When interest rates go up, the price of bonds falls. However, you can see here that at one point, the bond market was down 17% in 2022. Yes, it finished down negative 13. So far this year, as I mentioned, we're down about 3%. At one point, we were down 4%. The part that I want you to notice is the bond market is typically not down. But there's also a saying on Wall Street, bond traders are smarter than stock traders. So why are the bond markets down close to 4% for the year? I think it goes back to exactly what I was saying. In other words, hey, the economy is a little too strong. We don't expect the Fed to necessarily cut rates. Let me give you a quick visual on that. I said earlier, there's a relationship between interest rates and bond prices. When interest rates go up, the price of a bond decreases. When interest rates go down, the price of a bond goes up. Okay. The reason why I put bonds in here was twofold. Number one, bond prices are down today. If you buy individual bonds, there's a tremendous opportunity inside of the bond market today. It's one of the best I've ever seen. I know I said that about a year ago. If you can go back, all of these are recorded. They're on our website, and it was about a year or even a year and a half ago. Why? Because if you buy bonds, let's say you pick up a bond for $800, and let's say it matures in 2, 3, 4, 5 years from now, you collect that $200 because it matures at 1,000. Plus, let's say that bond pays 5%. So say you have a bond trading at 800, it matures 5 years from now, and it pays 5%. What you make on that bond under those circumstances is a 10% rate of return in an asset class, okay, that is very conservative, you know, depending upon the type of bonds that you own. So there's a tremendous opportunity in bonds today. This is a little busy, but one thing that I'm trying to point out here is when I look at 5 to 10-year bonds, people can lock in single A rated paper someplace between 5.5 and 5.9%. Hey, Derek, who cares if I can lock that in today? What do you mean? I'm getting my mouse stopped working. I'm getting, you know, 5.5% or 5.2% in my money market. Yes, I understand you're getting that in your money market. What you see on the screen today, and I snipped this just today from Schwab, is it's showing, hey, there's 5.3 in the money market. But here's what I want to say to you. Eventually, the Fed will cut rates. I'm not so convinced of it in the short term. I'm not even so convinced of it over the next 12 months. But eventually, the Fed will cut interest rates. When the Fed goes to cut interest rates, that rate that you're earning inside of your money market will immediately go down. In fact, it'll probably go down pre the Fed cutting interest rates. Therefore, if you were to buy bonds, you don't have the need for liquidity necessarily, right? You buy bonds, you lock in that rate. It's no different than like when you go to buy a house and they say, oh, you can lock in the rate. Well, remember, your money markets are variable today. Not saying, again, as I began this presentation, I'm not saying that you shouldn't own money markets. I'm just saying, if you're somebody who's owning a money market and you think you're always going to be collecting the 5 or 5.5, you may behoove you to lock in your rates using bonds. Because, okay, so where are we now? Just to give you an idea, you know, we always show these speedometers. Obviously, guys, we're coming to an end here in the presentation. But to create some, see if I can get my mouse back. Sorry, folks. It's weird. Well, anyhow, to give you some idea, if I go back to November of 2020, November of 2020, this is what our speedometers look like. Obviously, green is positive, yellow is neutral, and red is negative. Back in 2020, you can notice monetary policy, very accommodative, right? The Fed was cutting rates. The US economic outlook was cautionary. Remember, we were kind of like towards the tail end getting out of COVID. The yield curve was yellow, as you can see there. Consumer sentiment, how did consumers feel? It's no surprise that this is kind of what the speedometers looked at. Look at some of the green stuff. Housing and mortgages, right? Mortgage rates were super low. The labor market was dipping into the red, right? We were creeping out of that very high unemployment that spiked up. Consumers were still weary about spending, especially because of where the labor market was, but interest rates were super low. Fiscal policy, monetary policy looked very nice. Indexes, the stock market was recovering, corporate profits were again gaining, right, as we came out of COVID, so on and so forth. Inflation at that time, back in 2020, that's before it started to stick its ugly nose at us. Energy was pretty tame. It was slowly going up, but if you remember during COVID, oil prices hit zero, so things look pretty good. If we fast forwarded, about 2 years later, December of 2022. So if you were on this, is it gonna let me? Oh, there we go. Have to hit it, I guess. If I fast forward to December of 2022, that was at the end of that very bad market that we had, right? And remember, as we got into 2023, just in January, things kind of started to change. Our speedometers also started to change. But think about it, monetary policy, the Fed was raising rates, right? Look at all the stuff in red, housing and mortgages. We were way higher than we were just 12 months or 24 months. The yield curve, in other words, you got more interest in the short run than you did in the long run, okay? Today, that's kind of evening out. Interest rates were very high. Energy costs, right? Back in 2022, we're starting to kind of move down into the red, right? We started to go above 80. We had inflation creeping in. Here we are, 2024 in January, and actually did a bit of an update on these for May. So if I look at May, look at consumer sentiment. Consumers are feeling pretty good, right? You hear all the stuff in the headlines, but people are getting raises at work. They're hiring more people inside of the office. People have seen, after 2023, 401k balances come back, IRA balances come back. This year hasn't been that bad, although a bad month, okay? Housing and mortgage rates, right? They're kind of evening out around the 7. They've been around there for, by the way, no coincidence, since the Fed's been holding their monetary policy steady. Corporate profit growth, right? After this earnings season, you see that speedometer, right? It's hitting green, but it's going to move further green because it looks good. Inflation's coming down, although sticky. Inflation isn't at 9% like it was 2 Junes ago, okay? Valuations, you notice 2 of the red speedometers. Valuations are a little high, but those earnings, okay, are going to make that speedometer go back into the yellow. Geopolitical risk, I don't think we've ever had it in yellow or green. I think it remains in red, right? When I look at this today and you go, Derek, geez, you just showed me unemployment going up, wage growth going down, so on and so forth. We're at the end here, but so let me say, these are obviously potential headwinds. Inflation, if we see inflation pick up in any significant amount, these little tenths of a point, the market makes a big deal about them in the short run. But, if you think about it in the long run, Fed policy, where's the Fed going to go? I think the Fed did a poor job of signaling that, they were done with their rate hikes. I get it. I know everybody wants them to be done with it, but let's face it, they have that mandate. Potential headwinds are corporate earnings. I mean, we didn't know what this earnings season would look like, but it's been amazingly strong. It'll be very interesting to see in July what, Q2's numbers look like. And I bet you they're going to be pretty darn good because the labor market's so strong and you still have very good wage growth. Different types of competition. Obviously, we see things happening, overseas and all the different things that we see entered into the headlines last week with China. Do we enter recessionary pressures? And I guess all of that kind of goes with geopolitical tensions, which I don't think ever really leave. Tailwinds. We will see inflation start to because the Fed will do that.
Tailwinds, artificial intelligence, is that type of technology push us through that next 10, 20 years. It's not a straight line up, it goes up and down. Higher profits at companies, a more dovish Fed, meaning cut in interest rates and stabilization inside of China. Now, really, here's what I think. People are like, yeah, the Fed's going to cut. That should make the market rocket. It doesn't work that way. In fact, if you go back and you look at every time the Fed's cut, markets sell off. What? What do you mean? That's what pushed markets way up right at the end of 2023. Yeah, it did at the end of 2023, but the reality of it is, think about it. Unemployment goes up, wage growth goes down, Fed cuts rates. Why does the Fed cut rates? They cut rates to pour gasoline on the fire to make it warmer. It means that the backdrop of the economy is weakening. Make sense? And so when the Fed goes to cut rates, right, a lot of times you hear this in the headline: the Fed expects trouble ahead, trouble ahead. But I think the Fed, over time will cut rates. That's another reason why bonds look good, and we'll see stabilization in this. But the market today seems to be moving 100% based upon the Federal Reserve. I showed you earnings season. About 77% of companies have reported earnings above average. Earnings are the most important thing, okay? But if you think about it, why has the market had such a terrible month? We've gone through earnings season, which has looked very good, yet we had a terrible month in the month of April, and it's all having to do with the Federal Reserve and inflation, right? Those inflationary pressures. That's what's been driving the market for the last 2 years. The Fed started to raise rates in 22, market down 20%. Fed then kind of said, hey, we're going to see the effects of our monetary policy and we're raising interest rates and so on and so forth. Market kind of stabilized, and now the market's been dying to see the Fed cut. And why? When the Fed cuts, mathematically speaking, balance sheets get more profitable because the cost of capital goes down. However, if you're not selling widgets because unemployment goes too high, and that's the whole soft landing. Today, we're in a weird place. We'd like to see us get into a Goldilocks scenario. What I mean by a Goldilocks scenario is, you know what? I'm okay with inflation above there too, as long as wage growth. So as I've said, even in past presentations, if you have wage growth above inflation and it's sustainable with unemployment that's hovering around 4, okay, that's a Goldilocks type of scenario. Yes, we'd like to see those things come down, but remain in that Goldilocks area. We don't want to see unemployment skyrocket. Okay, here we are, the value of discipline. We've covered a lot of information. We focused on a ton. We're at the end here. You want to stay disciplined. When it comes to your investments, it's our job to help you stay disciplined. It is so funny to me. The easiest term is buy low and sell high. I can't tell you how often my phone rings with investors who want to sell low and buy high. When the markets are doing great, my phone rings, hey, Derek, I found an extra 100 grand in my bank. I would like to invest it. And why? I asked them, look at my account's up 23%. I want to invest it. What really should, that's just another way of saying buy high. What really should happen is when we have dips like we've had through this month, that's when new cash should be invested, because you are perhaps buying low. Now listen, in all markets, there are different areas to buy. There's different companies to look at. Obviously, I'm talking about the indices as a whole here. So steps for you to take. If you're a client of ours, keep us informed of your life changes, everything that's important, from money, moving, kids, that type of stuff. Tell us and talk to us about your investment concerns. We are here to help you with that. Put rationale behind it. I do not see anything in the marketplace today like we saw in 08, like we saw in 1999, where you had valuations at 250 PE in 99. In 08, right, you had Lehman go out, you had Bear Stearns go out, you had a handful of other financial companies that would have went out of business, and it was mayhem, right? Dow went from 14 down to 7. We stuck around 11 for a little bit. That was definitely a selling point. And make sure your essential documents are up to date. Should be in touch with us. We try to get in touch with you. I know you guys get a lot of email and stuff from us, but make sure this stuff, reach out to us. Steps for us to take. Get a new mouse. We'll keep you informed through regular communications. We'll manage your investments according to your personalized strategy. For all of you whom are clients and you know about our process. We learn everything about you. We craft your portfolio to help you meet your investment goals. We will remain abreast of the economic factors, and we will adjust those portfolios accordingly based upon, yes, we use AI, Monte Carlo simulations. There's a lot of pieces to the puzzle, okay? Listen, I went over. I didn't fulfill my promise. And until next time, this is me, Derek Eichenwald. Y'all know where to find me. If you'd like a copy of this presentation, we're more than happy to provide it for you. You can just email us and we will send it off. Thank you again. I'm signing off. Went over by a half hour. It's really bad, but maybe you can hit me if you want to watch this as a recording. You can put it on 1 times 5. Thanks again. Have a good evening, and we'll chat soon. Bye-bye.